So welcome back to Demystifying Indicators with Mike. So in this series, I'm going to start out with indicators, going through them, all the popular ones, breaking down the mathematics behind them. What do they actually show you? What do they make sense to be used, and in what context? Trying to remove the this is overbought, therefore I should sell it. This is oversold, therefore I should buy it nonsense that's out there. A lot of people trade these indicators and they haven't sat down and said, what is it actually designed to tell me? How is it derived? Is it necessary at all in my trading? That's the goal, to demystify them. So let's hop into it right here with the RSI. So the RSI stands for a relative strength index. And essentially what this is looking at is it's taking the average winner over a period of time, dividing it by the average losers. There's a lot more than that, but I'm keeping this incredibly simple. So for the RSI to move lower, it means there either has to be more red candles or the red candles have to be larger than the green candles. For it to move up, there has to be more green candles or larger green candles than red candles. That's it. So could you get this just by looking at the chart? Certainly. I have a Dollar General up on the screen here, and you can see the RSI has been pushing down, and you can see all of the big red candles here on the way down, right? All of these big red candles on the way down, therefore the RSI pushes down. Now, a lot of people will then use this and say if we're under 30, we're oversold and it's time to buy. And if we are above 70, it's oversold and it's time to sell. So I want everyone to sit and pause and take a second and say, does that make sense to you? That if a candle is selling with big red candles down and only tiny green candles up, is that something that you want to buy? In my opinion, no. Maybe short-term bounces can come from oversold levels, but generally speaking, if you have a candle that's putting in really big green candles and really small red candles, that to me is more a stock you want to own over the long run, maybe looking for some pullbacks in the short term. Now, another way that you can use this, and a way that I like to use it, is to look at it in a divergent sense. So for example, here with Dollar General, you can see we're making higher lows in the RSI, and we are making lower lows on price. So again, I always want to go back to what does the indicator math actually built off? Because every indicator out there is deriving price and volume, and that's all. So by having higher lows on the RSI, that means there is bigger green candles than there are red, or there's more green candles than there are red. And then having lower lows on price just means price is moving down. So if price is moving down, but intraday, the buyers are taking more control with larger green candles or more green candles, that could potentially signify a turning point. So that's going to be it for this first lesson. I hope this makes sense to you. I see a lot of people doing things out there with indicators that the math was not designed for, and really no sense, in my opinion, is made with them. So I just wanted to say, okay, we're going to sit down on every one to these short videos, and what does the actual mathematics show us, so that we can make sure that if we are going to implement these in a trading plan, we're doing it the right way. If you like this kind of series, hit the like button, share it around, and until the next time I see you guys, trade safe.